G'day folks, it's Jim here from Orchard Forex, and it's Saturday the 14th of August. Well, the markets have ended. The US dollar was a little bit weaker at the end of Friday trade. The ranges were pretty narrow throughout the week. It was a pretty uninspiring week in the FX markets. But we did see some dollar weakness on Friday after the release of the outsized fall in the consumer sentiment index. That came in 10%, at least 10% lower than expected. Came in about 70.1, I think it was, as expectations about 81.2. That was the biggest fall since the pandemic began. I don't think traders were really quite sure what to make of the number, to be honest. But anyway, it did see some dollar weakness, and it finished towards its lows of the week, albeit in narrow ranges. In the equity markets, the Dow Jones and the S&P both continued their slow grind higher on the back of the blockbuster earnings season that we're in the middle of, or coming towards the end of. And at the moment, we're ignoring the Delta variant and the possibility of an increased slowdown in the economic recovery. Commodities, they were pretty volatile last week. We saw that huge fall in gold early on Monday morning before the Asia Open. That fell $100 an ounce in a matter of seconds. It's since recovered those losses, as has silver. And gold actually closed the week slightly higher in the end, and it actually doesn't look too bad. It did receive some help from the weaker dollar on Friday and closed up about $25 an ounce, I think, on Friday. Looking ahead, we've got a pretty busy calendar coming up, although I think traders are going to begin looking towards Jackson Hole, which takes place on the 26th, 28th of August. In the meantime, we've got something on most days. I think the highlight of the week will probably be the RBNZ meeting, actually. That being because it does look as though they're going to be the first central bank to actually raise rates since the pandemic began, and with the possibility of looking for Kiwi rates to be back at 1% by the end of the year, which would probably mean rate hikes in August, September, and probably November. We have to wait and see on that one, but this Wednesday looks to be a distinct possibility for a rate hike. We'll go and have a look at the full calendar in a minute, but the highlights, they look to be, we've got Chinese data on Monday, the retail sales, industrial production. We've got RBA minutes on Tuesday, along with the EU flash GDP figures, and then later we've got the US retail sales and industrial production. On Wednesday we've got the RBNZ, as I just said. We've also got the UK CPI figures, building permits, and FOMC minutes. And then on Thursday we've got Australian unemployment. On Friday that looks to be a fairly thin session, but we'll go and have a look at the full calendar at the end of the video. In the meantime, we'll go and have a look at the charts, starting with the dollar index as per normal. Okay folks, so here we have a daily chart of the dollar index, and we can see we had this move lower on Friday from some 93 to 92.5, which basically means the euro went from 117.40 to 118. And as far as the index is concerned, we closed right on this neckline here, showing pretty much indecision all round, I think, on anything. The daily momentum indicators are pretty much running out of steam. They're flat. So I'm once again, unfortunately, not expecting a great deal of activity at the beginning of the week. If anything, I think we can probably see a little bit of further US dollar weakness. I don't think we're probably going back up here to these levels in at least before the FOMC minutes, and that's on Wednesday. And in the meantime, I think we're probably just likely to truck around here. As far as looking further ahead, if we go to the weekly charts, and here we have a weekly outlook on the dollar index. As you can see, we've been thrashing around the neckline here for quite a while now. The momentum indicators still look vaguely positive, so I haven't given up on the upside for the dollar yet, but it looks like it's going to make hard work of it. So as far as support and resistance levels go, that 93 level and 93.20, the highs of the last few weeks, and then this level up here, which the high there has been 93.40 by the looks of it, but I can't see us getting anywhere there anytime soon. On the downside, these lows come in here
at around 91.80, but that's still 70 points away, which given the current tight ranges, we're unlikely to see. If we go back to the dailies for a second, here we are back at the dailies, and below that 91 sort of 75.80 level, the 100 and 200 day moving average is coming at 91.5, 91.30. So if we get down there, that's going to be good support, but I don't think we're going to. Personally, I would say we finished the week right on 92.5, and I would say that 92, 93 will easily cover it heading into the FOMC minutes on Wednesday. So without further ado, we'll go and have a look at the euro, and we'll start with an hourly chart. And as you can see, we had quite a nice move in the euro. This is a very short term, of course, and this reverse head and shoulders didn't really start coming into play until the latter half of the week, and finally we saw this move up on Friday. And with the hourly charts being overbought, we're probably going to stall around here, but this could be a bit of a bull flag for a further run towards 18.5 early in the week. We managed to close back above, well, we took out the 100-hour moving average, we've taken out the 200-hour moving average, and so it could be a bull flag for another move higher. As far as the 4-hour charts are concerned, they've got some positive momentum too. So if anything, I prefer to be long the euro than short of it at the moment. The initial target, the initial FIBO target, would come in here at around this sort of 118.35 level, and beyond there, this sort of 119.05 to 15 level is going to be pretty heavy going. If we see it, I don't think we're going to get there ahead of Wednesday at least, but I'd prefer to buy dips towards 117.5 Monday, Tuesday, looking for a squeeze towards well, beyond 118 perhaps, to that was 118.35, and possibly up here, but I don't really think we're going to get there. On the downside, I'd be surprised really if we get back under 117.20, and I certainly don't think we're going back under 117 the figure early in the week. With the indicators are pointing higher. The dailies really not telling us an awful lot. They were pointing lower this time last week. They kind of seem to have found a bit of a base. Whether they managed to carry on with it is open to conjecture, but for the time being, look to trade that range. So 117.20, I think, hoping for a move to sort of 118.35.40, and having closed up to just under 118, I'd be looking to buy down around here at 117, sort of between 117.70 and 117.50 early in the week, probably with a stop loss below this 117.20, or ideally below 117. Moving forward to dollar yen. Likewise on the hourly charts, dollar yen seemed to form a bit of a head and shoulders. We have shoulder here, head, maybe second shoulder, and come Friday after that number, we saw the dollar ease back to 109.60, which has been the 50% pivot. If we go forward and look at the 4-hour charts, the 50% pivot of this move back up from here, and we're sitting basically back on it, which also coincides with the 23.6% FIBO level. If I need to close this up, so 23.6% of this move up from sort of the lows at 102.5 or so. So this level here is going to be important, 109.5, and if we go through there, well then I think we can probably move back down to 109, and perhaps possibly down towards this low here, which was supportive previously at around 108.70. The 4-hour charts certainly don't look all that healthy. They are pointing lower. Let's blow that up a bit. They look as though they are pointing lower. The dailies are really not telling us an awful lot. But we, as you can see, we're sitting on this FIBO. We have really just closed just below the 100-day moving average. And as I say, we could go back down to this 108.70 level. On the top side, if we get back above the 100-day moving average, which is pretty much at current levels, then I guess during the course of the week we can probably head back up to this 110.80 level. 110 is probably going to be resistance in the meantime. So for the time being, I think we probably just chop around. A lot will depend on the US bond yields. The dollar did not like the yields heading sharply low on Friday, and if we see a continuation of that move in the bond market, then that's going to keep dollar yen under pressure. But for the meantime, the dailies are pretty neutral. So I guess Monday, Tuesday, once again, as we've done in previous weeks, look to trade the 109, 110 range with probably a 30-point stop on either side, I think, on Monday, Tuesday, at least ahead of the FOMC minutes. Sterling, I won't spend too long on sterling. It did make a move back high on Friday, in line with everything else after the US data. I'm not really sure what's going on here. Maybe we are forming a bull flag, but it's really pretty range bound at the moment. Plenty of resistance above. We've got this 50% pivot here. That's above. That's at 139. Then we've got highs at 139, 50, 60, and again at 139.80, ahead of decent FIBO resistance. On the downside, well, the base of this area here, 130, just below 138, and I guess there's previous lows that's 137.60, 137.20. I don't really expect too much from sterling, quite honestly, at the moment. We have got the UK CPI out, I think, on Friday, but that's a long way off at this stage. The daily indicator, the 4-hour indicators, possibly pointing slightly higher. The daily's completely neutral, so I wouldn't really be too involved. I think, as we said last week, this 200-day moving average and the 100-day moving average being at sort of 137.70 and 139 and a quarter. Probably like to cover it again once again this week. So I'd probably trade that range, or even better, leave it alone altogether. I won't go into dollar Swiss, but the Aussie, that managed a bit of a recovery on Friday. As with everything else, the Aussie pushed up into dollar weakness, US dollar weakness. Whether we can sustain any strength remains to be seen. We're currently stuck in the 73, 74 range. That could well continue. Having said that, with the COVID, the Delta variant rampant through Australia now, most of Australia being in lockdown, it wouldn't surprise to see the Aussie suddenly crack to the downside, taking out this support here and moving low. But the 4-hour indicator is not really showing any degree of wanting to head lower at this point in time. The daily charts, they're also looking fairly neutral, possibly mildly supportive. But this does look a bit precarious to me, and if we do go through here, I think we'll probably see quite a swift run down to that, that's some way off, but a few analysts are calling for 70 cents further out. The FIBO level here is at 70.5, but there'll be plenty of bids on the way down. That's this low here, sort of 72.15 or so. And then there's various minor highs here, sort of 71.5. I don't think we're going to see it down there this week. But like I say, I am a bit wary. On the top side, if we do take out 74 cents, this previous high here, seen on the 4th of August at 74.25, that'll come into play ahead of 74.5, where we've got some FIBO resistance. But I don't really think we're going to be getting there for the time being. As I say, I think 73, 74 continues to cover it. But if we were to take out this low here, which that's on the 21st of July, around 72.90, then I think that's a different ball game, and we probably do start to head sharply lower. That remains to be seen. The Kiwi could be in for an interesting week. The market's now expecting the RBNZ to hike rates, so I guess any dips ahead of that will be seen as buying opportunities. We've got, if I go back to the hourly chart, we've got the 200-hour moving average at 70.25, the 100-hour at sort of basically just above 70, the figure. I guess they'll be bought into, certainly below anything below 70 cents. I think will be supported in the expectation that the RBNZ will hike. And if we do see that, this 70-80 level is going to be the initial minor trend resistance ahead of this 50% pivot and this high here, basically at 71 cents. And if we take that out, then I guess we're probably heading towards 71.5. And depending on how hawkish they turn out to be, maybe even back up to here. I don't think we're going there at this point in time. The 4-hour indicators not really showing us an awful lot. The RSIs are sitting pretty much in the middle. The dailies, they've been looking relatively positive, but they look somewhat neutral at the moment. Now, if we blow this up, we have got the 100 and the 200-day moving averages both sitting here at basically at 71 cents. So that's going to be pretty strong resistance if and when we do see it. But so all eyes will be on the RBNZ first thing Wednesday morning in Asia. Wait for that one, and that might have a few flow-on effects to other currencies if it's what the central banks are beginning to look to do. And then, of course, we have to wait for Jackson Hole at the end of August, when the central bankers all get together and we'll have a clearer picture of what the big boys are going to be thinking. Okay, so moving along, we'll go to have a look at gold. Okay, here we have a 4-hour chart of gold. We have this horrendous sell-off down to 1675. We've actually now got quite a double bottom down there. I don't think we're going back down there again for a while. Took a lot of people out who were long. We then having recovered from that, we mucked around for the first part of the week, and then we saw this recovery heading into the weekend, and basically we're back now almost to where we began, where we had this serious support here at sort of 1795. If we can take this line out at 1795, I'd actually start getting quite bullish on gold, I think, and with the possibility of heading back towards this sort of 1830 area. That remains to be seen. The daily charts, they did start to head quite sharply lower, I guess, on Monday, but ever since then we've squeezed higher, and it's taken some of the bearishness out of the momentum indicators. And I do think we could head high. We have got the 100-day and the 200-day moving average at sort of 1805 and 1810.15 respectively. So that's going to be big resistance if when we get there. But if we do get above that, then I think we can start to head towards higher ground. There remains to be seen, but my overall view at the moment is to be buying dips. Where would I be looking? Probably back down around this sort of 1750-60 level, I think, is where I'd really want to start, and then I'd have a stop loss probably below where this low here, 1740. I'd probably have a stop loss below 1730, but if I could buy it in the 1730 to 1750 area, I think that's going to end up looking quite cheap down the track, particularly if we do see a weaker US dollar. That's certainly going to help gold out, so something to keep an eye on. Moving forward to oil, well, West Texas had a choppy week, trading really between sort of 65 and just under $70 a barrel. We've ended up just below the 100 and 200 hour moving average. The 4-hour chart's not giving us any real hint either way, so I think it's probably going to be choppy, and direction's going to come from, well, A, the data, but also how the Delta variant continues to build in the States. If they can get that under control, then I think oil will probably head higher. In the meantime, I guess we continue to trade that range, that sort of 65-70 range, but I'd be keeping stops pretty tight either side. The daily charts not showing us a great deal. We did finish pretty much on the 100-day moving average, and I suspect that will continue to provide support. So I'd look to buy it towards 65, sell it towards 70, but with a fairly tight stop loss on either side. Moving forward to the stock markets. Okay, here we have a daily chart of the S&P 500, and the never-ending march continues higher. On Friday, the S&P actually made its 48th new all-time high since December. That's completely crushed, really. I think all the experts who've been looking for a top and a correction lower, I have no doubt we'll eventually see one, but for those who've been calling it for the last couple of months, they're well underwater by now. As I say, this is a daily. I just don't stand in front of this thing, because I can see that it will continue to march higher, albeit very slowly. With bond yields collapsing again on Friday, there's really nowhere else to put your money. So I think, and there's a whole sea of cash waiting to find a home, and it's obviously not going to be earning a great deal in the bond market. Let's go and have a look at the 4-hour charts. They, if anything, look mildly positive again to start the week, possibly becoming slightly overbought, but if we do see a correction lower, let me go back to the hourly charts, I think. So here we are. If we do see a correction lower, it's 44.50, and below there, 44.35. We've got the 200-hour moving average at 44.30, and there's plenty on the way down. With the first FIBO level coming in at sort of 44.12. The hourly indicator's not showing us an awful lot. The 4-hourlies look mildly positive, if anything, and the dailies equally, they're looking very, very mildly positive. And I just think the slow grind higher will continue. I'd be going with it and using a trading stop loss according to your own parameters, really. I don't see any reason at this point in time to alter the view, although having said that, some caution is possibly required ahead of the FOMC minutes. And if we are going to see a peak in the stock markets, I would actually suspect it might come the following week as traders become a bit conservative ahead of Jackson Hole and possibly do a bit of profit taking, which could send the indexes a little bit lower. But in the meantime, just stay with it, I think, is the way to go. The Dow and the Nasdaq, pretty much the same. The Aussie market I've been following. I really like the Aussie market. And here we have a 1 hour chart. Now, despite all the COVID bleak news out there, I suspect the trend is going to continue higher. We did see a bit of a sell-off in the futures markets in New York on Friday, but the local market, it closed really towards its all-time highs, up here at 76.40 or so, and came back and finished at 76.15. 100-hour moving average 75.80, the 200-hour moving average 75.5. Looking ahead to the 4 hour charts, they're possibly a little bit toppish. It wouldn't surprise me to see a bit of a correction lower early in the week. It is reporting season here, so we've got a lot of numbers coming out, which may confuse the issue. I think the overriding fact is where COVID's going. I'd be amazed if we really push on to aggressive new highs while that's occurring, but the market seems to be ignoring it for the time being. So for the 4 hour charts look a little bit heavy, but I'd be a buyer into dips, I think. The daily charts, the indicators still look positive, so I don't see any reason to go against it. The weeklies equally look, they don't look as though they're turning down. Let me just update that. The indicators may be coming mildly overbought, but they're not showing any signs of turning lower at this stage. And the monthlies look very positive indeed to me. So I think longer term, we're going higher. My game plan for the time being, though, is to be buying dips. I wouldn't necessarily be buying it at these levels at all-time highs. But if we were to see it back down here, which now seems some way off. We're sort of talking 7,200. That's 400 points away, which was only 3 weeks ago. So we could easily see that kind of dip. But overall, I think we're probably heading up higher down the track. Okay, so we'll just go and have a quick look at the calendar. Okay, so here we go. On Monday, we start off with the Japanese Q2 GDP. And the other main event of the day will be the Chinese data coming out, the retail sales, house price index, and the FAI. Beyond that, there's not an awful lot. Tuesday we start off with the RBA minutes, and then we get the unemployment numbers and the Q2 GDP from the EU, and that comes ahead of the US retail sales, which will be the main event of the day. Although also we get the industrial production, the capital utilization, business inventories, that sort of thing. So they'll be all closely watched. Wednesday we start off with the New Zealand PPI, but the main event of the session will be the interest rate decision, as I said before, and the monetary policy statement. We'll have to wait and see on that one. Also due on Wednesday will be the UK CPI data and the EU CPI data as well, and they come in ahead of the FOMC minutes, which will be closely watched indeed. Thursday, Australian unemployment, not expected to be a flash number given the lockdown situation. A loss of 45,000 jobs looks to be in the air. So that consensus may see a bit of pressure on the Aussie, particularly it comes in worse than 45,000. Elsewhere, later on in the day, we get there's some secondary data out of the States, the Philadelphia manufacturing figures, of course the weekly jobless claims, and then we really go quietly into the weekend. There's not an awful lot. We got the monthly PBOC interest rate setting, and the Canadian retail sales, as well as the UK retail sales as well on Friday. But that's really about it for the week. And then the following week, of course, we've got Jackson Hole, which a lot of traders will be looking forward to. So that's about it for the coming week. It's going to be a fairly busy one on the calendar. Not sure how much we should expect out of the foreign exchange market. Stocks, I think, will probably, in the absence of anything else, probably just continue their slow grind higher. We'll have to wait and see. So until next week, have a very good week's trading, and we'll talk to you then. Cheers, bye.